Good afternoon. Thank you for your time before lunch. Today I want to give you an unapologetically sciencey talk, and there's sort of two reasons. One is that there's a clash of cultures between the science and engineering culture, and let's call it the traditional economics and corporate culture in trading world. And I'm going to give you a glimpse into a recent breakthrough in our understanding of financial markets that is probably on par with Black-Scholes-Merton. It's a quiet revolution, and it's important for several reasons. The first is that it tells us why price impact is the square root law, why when you trade a share and the share price moves, it's actually proportional to the square root of the volume of your trade. Why is that important? Because it actually tells us how we can simulate stock markets. So the simulation of stock markets is now a solved problem. And that has really interesting kind of implications for the simulation of your technology stacks and also kind of proving technology stacks. The other thing, which is a little more contentious perhaps, is that it actually de facto rules out maths of finance as the right way of understanding stock markets. For most traders, this seems self-evident, but it has some big implications in how we kind of do research. So the basic idea is that you take a parent order, and the parent order is made of a sequence of child orders, and you inject those child orders into the market. So this is a picture from Fabrizio Lillo, one of the discoverers of the theory, and a little sequence of buys, so buy, and they all get mixed in the market by many traders. This is the intraday market. The theory tells us that the intraday market is completely different from the investment problem. The investment problem categorically runs from closing auction to closing auction. Those are auctions, completely different price discovery. So these are completely different worlds. That has some very interesting repercussions for people who do investments as opposed to trading. These worlds actually don't mix nicely. So what is the theory? So this is where it gets a bit mathy, and I apologize, but it's worth the effort. So these guys, Yan Sato and Ken Kanazawa in 2023, they took 9 years of all the trades on the Tokyo Stock Exchange, and they had all the metadata information, so the broker information, all the parent orders, and with that information, they then verified this theory, which became known as the Lillo-Mike Farmer theory, after Fabrizio Lillo and Mike and Dwayne Farmer. The theory is essentially that if you know the distribution of all the meta orders, is given by some parameter, the form is not important, you can then completely explain the memory on the orders. So if it's a buy, then a sell, then a buy, the memory in the order flow is completely explained by the microscopic structure of the parent orders. There's nothing else going on. It is just order flow. So what? So this is the cartoon of it. The cartoon is that on the one side, you've got this little parameter gamma, and all that is saying is that the memory in the order flow that you see in your actual trading algo is completely explained by the distribution of the meta orders. So what? It tells you that you can actually reverse engineer all the private information from the public information about all the traders. That I can, in principle and in practice, reverse engineer your parent orders from public data. So just think about that. This is actually kind of a game-on moment. So it not only explains the square root law, so the little impact is driven by the square root of the volume, and this is some work we've done at the JSC to verify this. So one of the reasons why I'm here is the JSC have kindly provided us data to actually verify the theory on the JSC. And the straight line is the square root law for price impact, and this is for 100 trades over a 3-year period, and it kind of fits it. So this is just to convince you, this is backed up by empirical information on the JSC. So this is the actual graph in the paper that kind of started this little revolution, and it's worth staring at because the magnitude of the experiment is extraordinary. We're talking about 9 years of every trade with all the broker information and investor information analyzed. And it's essentially a straight line So this is this memory parameter, that the memory of your trades is linked to the distribution of the parent orders, and it's a straight line. The left-hand graph uses the traditional method, and the right-hand graph uses kind of a Fourier method. The details are not important. But what is important is this theory has been empirically verified. And the reason why that is important is that even if you don't know the meta orders, you can kind of guess cleverly with machine learning how many traders are operational in a market at a given time, what their kind of flow is like, and with that, you can reverse engineer the parent orders. So this is the verification of the rule on the JSE, which we kindly did at the JSE, and thank you for that. And that has allowed us to build a replica of the JSE, so we can now fully simulate the JSE. This is a 25-second block for one share. You can get the details if you just message me. So just in a closing point, more kind of mathy, statsy pictures, look at the yellow line. So the yellow line here is a nice decreasing, slowly decreasing line. The yellow line on that graph is fast. The difference here is that this is the memory in the order flow. This is the memory in the stock prices. What that is telling you is we know why stock prices are not predictable, and they are not predictable, but the order flow is. This is a major problem for maths or finance. So this is really a game-on moment because it tells us why the machine learning technology works and how to use it. I hope that's kind of interesting. And thank you. If you want any questions, please shoot. Nothing. No questions. So yes, go for it. Anything. I don't mind any contentious questions or whatever.
Thanks for that. We like colors and graphs and mathsy stuff, so that's good. But maybe just to, I think more importantly, to understand from what you've compared, whether it was Tokyo or the models from the 9-year precedent that it's been said, and you said, yes, there's predictability in us taking the data and using it, and that's what even rise from various proprietary trading shops globally. That's their business model now. You know, that's these HFT firms, they have trading strategies, etc. But if you have a look at the South African market from what you've pulled out here and activity on the JSE, does it look like a healthy marketplace in comparison? What does it tell us of the output of the marketplace?
For the JSE data, it's a square root law, which means the market is actually quite liquid. I mean, if you go back to, the graphs are not there, but there's a graph there which tells you that the small trades, this one. The small trades are problematic. So there's very little value going on in lots of fast small trades, unless you've got a longer term signal. So that's telling you you've got to have some side information to kind of profit down there. These are large upstairs trades, but generally the market's quite liquid. So I'd say it's a healthy market. Yeah. Surprisingly so for its size.
I think it's not surprising, but we've built a narrative that we're not a liquid market, but in fact we are a liquid market. And I think this is a, you know, yes, we had a decade overhang, and I'm selling the SA story, but I do think it's important in this chapter. We are a 30 billion rand market a day. Yes, we know the merits of why it's concentrated in the top end of the market, but that top end of the market is healthy and globally comparative. So thank you for endorsing that we're a liquid market. That was not what I was intending to come out, but just to get it unbiased. But I do think that's a narrative we must hold now when we're fighting for global flows. South Africa is not just a marketplace because we increased in weighting in indices, but South Africa is a marketplace because we are liquid and we have depth of market and we have globally relevant companies and market infrastructure and participants that will support flows. It's I think it's very healthy to keep this momentum. We're all asking how we're going to sustain 30 billion, and I think it's saying we have a liquid market and actually showing that. So thank you.
Agreed.